Hey, welcome YouTube universe. It's me, E.T. Clark. And remember, I am not your financial advisor. I'm just a self-taught investor who likes to talk about stocks. I told you guys I was going to do this video. This video here is really just going to concentrate on the two huge mistakes that I made in my 52-week money challenge. My 52-week money challenge, of course, starts at the beginning of the year in January, ends in that last week in December. And the goal of this challenge was to double the initial amount that I put into the account. I established an E-Trade account, put $12,000 in. I want to double it to $24,000. And I wanted to do this by selling premiums for income. And trust me, when we started out, we were rolling. We were on a roll. We were beating all the indexes. And then I made some very, very crucial mistakes in the month of February. I violated my trading rules that I had for myself. And as a result, it came back and, hey, smacked me upside the head, and it hurts. So I decided to go ahead and do this video. I release a video every week about how I'm doing when it comes to the 52-week money challenge. And I wanted to talk a little bit more in depth about the two mistakes that I made, two huge mistakes when it comes to these two particular stocks. So we've got a lot of information to digest and go over, so let's get into it. The very first thing I want to do right off the bat is I want to go over the rules of engagement, or the rules that I have for buying and selling options for income. So I have some rules, and I've had them for a while, and I've broken them before, and probably got about a 50-50 success record. 50% of the times when I break my rule, it doesn't come back and bite me in the butt. I'll win. And the other 50%, I lose. But trust me, if I always follow the rules, I have not had a loss from following these rules. So that's on me. So let's go over these rules. All right, the first one that I have is don't chase a stock or premiums. And when I say chase a stock, I'm talking about the stock price. All right, we're in this business to make money. Every investor out there is there to make money. We're no different than a business. That's why we do what we do. And the key in investing, regardless of whether it's equities, or real estate, is to buy low, sell high. That's what I mean by don't chase a stock. Don't chase that price. If a stock is running up and you want to get involved and you're afraid of missing out, don't chase it. Don't buy it at the high, because what's always going to happen, always, it's going to reach a high. It's going to reach a peak. And when it hits that peak, it's going to peel back. And when a stock takes off like that, we don't know where that peak is going to be. So don't chase the stock price. But also, since we're in the business of selling premiums for income, don't chase that premium either. All right. And, sometimes those premiums look pretty good. It could be deep in the money, or it could be a lot of volatility that's going on within that stock. And those premiums, if there's more volatility in the stock, the premiums go up. Okay. That's the Vega. So don't do that. No, don't do that. All right. Another thing, rule that I have is that I want to trade only stocks that I like. All right. I'm a long-term investor. I invest for dividends, and I trade a lot. And most of my trades, just about all of my trades on my various accounts, if it's classified as trading, I am selling premiums for income. And I make it a point to only go after the stocks that if I get them, if things change, I wouldn't mind holding on to those stocks for the long run. So I only trade stocks that I like. I don't trade a hot stock that is, that's running in price and very volatile in price. If I'm not interested in holding it for the long run, if I decided to stop trading that stock. So also another rule that I have is avoid earnings. Okay, this one here, what we're doing right now is we're in and out of a stock within a week. Beginning of the week, we sell premiums and we close out of that particular stock by the end of the week. One of the things you got to do is you want to check the earnings. Make sure that the earnings don't come out during the time that you are either buying or selling an option. Even if the earnings are good, I've seen it where the earnings are good and the price still tanks. So we just stay away from it altogether. Check the press releases and news to see what's going on there. All right, that's a gimme for anyone. And what I use also is you need to use fundamental analysis and technical analysis. Use them both. And I know you have people in different camps there. They're only fundamental investors or you're only technical investors. I look at it a different way. I look at fundamental analysis as where we're looking at the numbers, revenue, growth, things like that there. That's great. A fundamental analysis will tell me what to buy. The next analysis that I'm going to look at is going to be a technical analysis. Now, a technical analysis, we're looking at the charts. And a technical analysis is going to tell you when to buy. This is telling me that, okay, fundamentals look good. Earnings look good, growth looks good, not a lot of debt. Sometimes you're going to be dealing with a new startup company that may have debt. Okay, I'm okay with that, provided it's got to have exceptional growth rate. So that's telling me, okay, that's the stock that I want. Now I got to use my technical analysis to see when do I get in. And I try to keep it simple. That old KISS method, keep it simple, stupid. Okay? That's what I use for me. And I only really concentrate when it comes to technical analysis, really just on two indicators. The Keltner channel and the RSI, the relative strength index. That's it. This tells me whether or not the stock is either overbought or oversold. Okay, it's an indicator. This here, the Keltner channel, shows me if a stock is running in a channel this is the channel of a stock, if the current price is, let's say the current price is here on this top line, that's the line of resistance. And if it's here on the bottom line, that's a line of support. Remember, buy low, sell high. Buy. Sell. And if you notice this middle line there, that midsection, that's normally what I normally do. I don't buy here if it's getting close to the resistance. I'll wait till it crosses under that mid. If it crosses under that mid, then I start looking at realistically buying. Identify the stocks that I want to buy. Watch my Keltner channel. Once it hits below that mid, I'm almost ready to pull the trigger. I'm going to pull that trigger. I'm going to buy. All right. Those are the rules that I have. So what happened? If I have these great set of rules, what the hell happened, E.T.? Why in the hell are you doing this video on the mistakes that you made if you got a good set of rules? And the reason why I'm doing it is because I violated my own rules and it came back and it bit me in the butt. All right. Hey, YouTube universe, sorry, we had technical problems, and because of that, I have to reshoot this particular portion of the video. So let's get back into it. Now, the two stocks that were giving me the biggest problems and really caused me to be underwater is Apple and ChargePoint. So let's break it down and take a look at Apple. I'll give you the backstory on Apple and how it relates to me violating some of my rules. So with Apple, here's the backstory with Apple. On the 2nd of February, 2021, I went in and I bought a call option, a LEAP call option with an expiration date of March 2023, 2 years out. And the strike price for this was 120 bucks. Now at that time, Apple was trading at $134.99. So with me going out and buying this call LEAP option, the price for that was $38.30. So the total amount that I paid for this LEAP option 2 years out was $3,830.60. That's the total price that I paid. Now, as of today, as of the recording of this video, the price of this option now is worth $28.90. In other words, $2,080.90. So what this does is puts me currently underwater for this play. I'm underwater now, $940. The reason why I bought this option is because I wanted to write covered calls on it. I have two options when it comes to covered calls. I can either do a deep in the money LEAP, which I did. This is like $14, almost $15 in the money, and a LEAP, more than a year out. This one here is 2 years out. All right. The advantage to that is now I get to control 100 shares of Apple up until March of 2023, unless they take it from me. So it cost me $3,800. If I would have bought 100 shares of Apple and wrote the covered calls the traditional way, I'll be out of pocket $13,000. All right, so what happened is once I bought this, the price of Apple went down. When I bought it, the price of Apple was skyrocketing. About 2 months prior to that, when I really was thinking about writing covered calls on Apple, that was back in December, Apple was running like 114, 115. And all of a sudden now it ran up. And as a result, I bought it and I violated some of my rules. The rules that I violated were two on this board. Number one, I chased the stock. I chased the stock because I kept seeing that price going up and up and up, and I wanted to get involved. So I decided to go ahead and pull the trigger with the poor man's covered call. Don't do that. I know better. I did it anyway. Bad on me. And another thing too is the Keltner channel. When I looked at it, it was actually above the resistance. I shouldn't have bought it. Not at the resistance. You wait until it gets to the mid or below. I bought it up here. No. So 2 rules that I violated. As a result, I went underwater along the way. Now, the beauty of selling premiums for income is this here. When you sell premiums, you immediately get that money. So even though I went underwater, I sold a total of 7 covered calls, collected a total of $309. All right, so if you want, you can look at it this way here. And this is another advantage of writing covered calls. Even if your stock or the market is going down, you're mitigating your losses. I want you to think about this. If I had bought the stock at $13,000 and it went down to $120, I've lost a lot of money. All right. And that's it. All I can do is wait for a rebound. By writing covered calls, I mitigate this. This is what I mean by mitigation. I'm currently down, as of the current price, as of the taping of this video, $940. But I was able to collect $309 from this. That gives me a difference of, that really mitigates my loss down to $631. And guess what, guys? I still own the stock and I can continue to write cover calls on it. But I'm not. What I'm going to do is I'm going to wait for the price to start to appreciate. I think what I'm going to do is just hold off now, and I'm going to wait until the price of the LEAP gets to about $32, $34. Then I'll start writing cover calls again. So that's what I'm going to do with Apple. Let's take a look at ChargePoint. So on the 22nd of February, I was assigned the 2 contracts for a cash secure put that I wrote on ChargePoint. That means that I bought 200 shares of ChargePoint. The strike price was $38. All right, prior to that week, I sold a cash secure put, chasing the premiums, something that I was not supposed to do, but I did. And for that week, I received, for that cash secure put, I received $726. And ChargePoint was actually above that strike price. All it had to do was stay above that price, that strike price, for just 1 week. And I wouldn't have been assigned, and I could do it all over again. It fell below the $38. On the expiration date, it closed below $38. And guess what? I was assigned 2 contracts, which is 200 shares. So I paid for that $7,600. The current price of ChargePoint as of today's taping was $25.65. So the current value is $5,130. So that tells you right there that I am currently looking at a unrealized loss of $2,470 on ChargePoint. But just like with Apple, I was able to write covered calls and cash secure put. Then the whole time that I was working with ChargePoint, I was able to write a total of 5 cash secure puts and 8 covered calls for a grand total of $1,351. Now, might as well just put it right up under here. That's a plus. $1,351. So that reduced my cost basis. That reduced my losses, my unrealized losses, from $2,470. And you could look at it as $1,119. Once again, by selling options for income, you mitigate any losses that you may have within that particular equity or stock that you have. So that's one of the beauties of it. Now, if you just add up both of these here, this is what the numbers look like. If you add up this loss here and this loss here, that's going to come to $3,410. If you add up the money received from writing covered calls and cash secure put, if you add those two up, that comes up to $1,660. So overall on both of these, I'm only down $1,750. Now, I still own both of these. I still have control of Apple, and I still own those 200 shares. What I'm going to do with Apple is I'm going to wait for the price of the leap to go up. Once it goes up, I'll go ahead and write more covered calls in it to reduce my basis. I'm almost out of the hole on this one altogether. And I'm going to do the same thing with ChargePoint. Once again, that is the beauty of selling options for income. If the market turns on you, if your stock turns on you, whatever you're writing covered calls on, all that's going to do now is mitigate your losses. It's not necessarily a win-win, but it makes it a lot less painful. But also, it gives me the opportunity to dig myself out of the hole and eventually sell both of these for a profit. So I hope this was informative for you. And hey, I'll keep you guys abreast on how this works out with my weekly updates on my 52-week money challenge. Okay then, guys, take care. Bye-bye.